Hello, my friend. Welcome to Charley Retail Invest. Let's track the latest trend in US economy and share our recent investment in stock and bond markets. In the episode on August 4th, I shared with my AI investment system's prediction for the US stock market trend in the next few weeks. You could go back and look at our predictions at the time. The S&P 500 index was likely to reach a bottom around August 21st. That's what our AI system predicted. Furthermore, there was a small probability of less than 40% chance that the index would bottom out around 5,700 points. Overall, the AI system prediction is somewhat accurate, even though the S&P 500 index continued to climb for 2 weeks after August 1st, reaching a new all-time high around 6,487 points on August 15th. However, in the next few days, as the market sold off technology stocks, the S&P 500 also fluctuated downward to around 6,380 points. We can see that the first phase of the bull market, in which case the US stock index rose steadily at a 45-degree angle up over the past 4 months, has terminated. Therefore, in the next few weeks, the market will officially enter the autumn correction period. The situation is even more pronounced for the tech-heavy Nasdaq 100 index, which reached its all-time high of 23,916 points on August 13th. Over the past week, the Nasdaq has lost 3% of its market value. During this correction, the Nasdaq 100's decline is likely to be 1.5 to 2 times higher than that of the S&P 500's retracement. Those that are holding tech giant stocks should be prepared for a downturn in the coming weeks. Please hold on to your holdings and don't panic sell, and let Wall Street crashing tactics scare you into panic selling. Please don't do that. And the key question is, where exactly are the bottoms for the S&P 500 and Nasdaq index, as recently calculated by my AI system? When can we fully release our cash position to buy the dip on Wall Street? Please click subscription to Charley Retail Invest and share this video if you like. Just kidding. This is the latest prediction from our AI system. Over the next 2 weeks, from August 21st to September 3rd, we are likely to see a periodic bottom for the S&P 500 and Nasdaq 100 index. At present, the S&P 500 is most likely to hit an area in between 6,065 and 6,180 points, which is the area that we marked with the green rectangle. And then it can start rebounding and slowly returning to the upward trend where we can see new all-time highs. Now the S&P 500 index is around 6,380 points, and it still has about 3.3 to 4.9% room to fall to form this stage bottom. Of course, some of you might be a little bit disappointed with this result because we originally expected a more severe correction of at least 10%, and the S&P 500 index would fall below 6,000 points to create a more comfortable buying price for us. However, the current situation is that although most institutions have already bought their stock positions, once the US stock market falls, retail investors who haven't entered the market yet or some other institutional investors will actively buy into the dip. This will make it very difficult for us to experience a panic sell-off in US stock market like what we saw back in August of last year. Unless there is a black swan event like the yen carry trade again or a Middle East war that occurred suddenly, this correction is likely to be short-lived and shallow. The deeper reason behind this is that the Federal Reserve will resume its pace of cutting interest rates after the FOMC meeting on September 16th. As the dollar continues to depreciate and the Trump administration works tirelessly to stimulate the US economy, major indices like the S&P 500 and Nasdaq are very likely to repeat the explosive growth that they've been experiencing in the previous low interest rate environment from 2020 to 2021. and this would cause the US stocks to grow even faster from the second half of 2025 to the summer of 2026 compared to the bull market in 2023 and 2024, ushering a final frenzy. Of course, the premise for this crazy bull market is that the US economy has not actually fallen into a recession. This is also the conclusion that I came to after conducting extensive and in-depth research on the US economy. If, on the other hand, the US economy does not recover, but instead falls into a substantial recession, then we would see a repeat of the bear market crash from 2007 to 2009. Of course, the probability of this happening is very low, so I will not consider it here for the time being. However, if we expand the time scale and only look at the next months, we will see how the US stock market will perform. The Federal Reserve Chairman Powell's statement will likely be a key factor in stimulating a rebound in US stocks or in spooking the market. And this weekend from August 21st to August 23rd, the Federal Reserve will hold its annual Top Global Economic Conference in Jackson Hole, Wyoming. Central bank governors, finance ministers, and famous economists will participate in this meeting from all over the world, and the market will be watching Mr. Powell's comment on the current U.S. economy during this meeting, and in particular, will the upward trend in the PPI due to Trump's tariff policy affect Fed's pace to cut interest rate? If Powell continues to sound hawkish, saying he will wait and see if inflation falls before deciding whether to cut rates, then the market is likely to sell off US stocks, triggering a panic sell-off. If Powell, on the other hand, takes a more dovish stance, saying that a rate cut is likely imminently, then the market could see a significant rebound. Of course, no matter what Powell says during this weekend, the market would predict that the probability of next Fed cutting interest rate by 25 basis points in mid-September is still as high as over 84%. Personally, I do believe that although Powell is very reluctant and he wants to better suppress inflation, the American public opinion has forced the Fed to start cutting interest rates immediately because the U.S. real economy can no longer withstand the high interest rate environment for more than 3 years. Except for those tech giants like Microsoft or Google, most small and medium-sized enterprises are facing a miserable time because they can't raise money due to the high interest rate. And the Federal Reserve has to lower the benchmark interest rate to below 3% to make them thrive again. Therefore, from late August until mid-September, when the Fed actually starts cutting interest rate, we are likely to see continued volatility in the US stock market, and there's even the possibility of a sudden decline. Here, I suggest that everyone wait patiently for a few more weeks or days until the S&P 500 index falls below 6,180 points, and then you can consider buying the dip using index ETF like SPLG, QQQM, SPMO, VGT, or FNGS. Once you've bought your stock ETFs, please leave them there and ignore the volatility. Don't panic selling over temporary fluctuations in these stock prices. Just watch the major US stock market breaks through their all-time highs in the fourth quarter of this year and continue their upward trend and enjoy the ride. So over the past few days, Palantir, a hot new AI technology company, has seen its stock price plummeted after reaching an all-time high of $190 per share on August 12th. By August 20th, the stock had fallen back to around $152, which is a drop of more than 20% in just 1 week. This isn't too surprising though, considering Palantir's stock price has already risen by 106% by 2025 and a whopping 380% in the past 12 months, while its EPS growth rate is also very high at 56%. The company's net income growth rate is just far slower compared to its stock price growth rate. And even after the plunge, Palantir's PE ratio remains at a staggering high of 577, and its 1-year forward PE ratio is around 234, both significantly exceeding the S&P and Nasdaq averages. And its PEG ratio, or the ratio of its PE to its revenue growth rate, is also at 9.9, which is over 7.5 times higher than that of NVIDIA. Seeing that Palantir's stock price bubble was so big, the well-known short-selling institution Citron Research could no longer sit still. So it released a report on August 19th, pointing out that Palantir's stock price was seriously overvalued and is completely disconnected from its fundamentals. The report compares Palantir with OpenAI, which has yet to go public. Citron said that OpenAI's latest funding value is around $500 billion, based on its projected revenue of $5.6 billion in 2026. OpenAI's price-to-sales ratio is around 17 times. However, Palantir's price-to-sales ratio is a whopping 118, which is about 6.9 times higher than OpenAI. So if Palantir were priced based on this multiple, its stock price would fall into around $40, not $150 a share. And even at $40, Palantir would still be one of the most highly valued software companies around the world. At the same time, Citron also pointed out that Palantir will face fierce competition from Databricks and Microsoft in the enterprise market in the future, which may affect the company's future revenue growth rate. I do believe that Citron's fundamentals make sense. However, the market is still clearly in a state of intense pursuit of Palantir stocks. It's quite difficult, frankly, to see Palantir's stock price falling below $110 in the next 12 months. On the contrary, it's precisely because of Palantir's close relationship with the U.S. government, especially the U.S. Department of Defense, that it has the support of both the AI technology upstart and the defense industrial complex, two hotspots pursued by the investing markets. So unless the Republicans suffer a crushing defeat after next year's midterm elections, and the Democratic-controlled Senate and House of Representatives begin to question Palantir's long-term cooperation with the U.S. government, we may see a major pullback in Palantir stock price under that scenario. However, in the coming weeks, if Palantir stock price fall below $140, perhaps in between $130.7 to $142 range, it could be a good entry point. I'll keep you guys updated if there is a good chance to actually buy into Palantir stocks in the near future. Next is CRI investment recommendation. As the US stock market starts to pulling back, the AI investment system recommends gradually increasing the proportion of US stock indexes or individual stocks and reducing the proportion of short-term treasury holdings. So for US stock, you can allocate up to 55% of the entire portfolio, and you can consider buying the dips on Lululemon stock around $197, buying TTD stock around 52.3, and buying Figma around $75. And the US index are still relatively expensive, so our system doesn't recommend buying at current prices. As for gold and Bitcoin ETFs, the system still recommends maintaining the proportions of 20% gold and 10% Bitcoin unchanged, respectively. If the US stock market continues to decline in the coming weeks, our AI investment system will likely continue to increase its holdings in stock investment and buy more US stock indices. We will wait and see. This is the latest CRI portfolio holdings as of August 20th. We sold our remaining Google positions to lock in 15% short-term profit, and we will use the capital to purchase more Eli Lilly stocks at a cheaper price, and also we will buy more defense and military ETF XAR. As for other stock allocations, they remain unchanged. This is the return of CRI investment portfolio as of the last trading day, August 19th. Our total return in 2025 remains above 12%, which is significantly higher than the return of S&P 500, around 99%. We hope that our investment portfolio will continue to outperform the broader US stock market in the coming period. And that's the whole story of today's video. If you are a retail investor like myself and would like to follow our highly effective AI investment system to make a ton of money and become financially independent, please consider subscribing our channel, Charley Retail Invest. Thank you so much for your time and support. I'll see you in the next video. Please take care.